Welcome to our latest quarterly update. I'm joined once again by Greg here, our Global CIO Multi-Asset, to give us his thoughts on the coming quarter and some ideas around portfolio positioning. Hi, Greg.
Hi, Peter.
Thanks for joining us again. So, since we last spoke, how do you see overall changes in the risk situation?
Overall, we see global macro data remaining quite robust, but marked by regional disparities. While the US economy remains solid, gains in the industrialized world have largely been driven by a strong rebound in the Eurozone. Emerging market readings also improved, with Chinese macro indicators strengthening for a 7th consecutive month, something which perhaps remained under the radar of many investors. On inflation, we mentioned in the past that the last mile would be the most difficult one, and indeed, recent data showed signs of stickiness, with core inflation turning positive again. Coupled with higher oil prices, this certainly explains why government bond yields have recently trended higher. All in all, we're still expecting a soft landing. It looks like market participants have increased the probability of a no landing of the economy. This would mean fewer interest rate cuts by central banks, but also by the growth expectation. And this means in this environment, for us investors, we maintain a relatively constructive view on risky assets, with continued good news on providing positive momentum.
So looking more specifically at equities, how are you currently positioned?
Well, Japan is and has been our preferred region for a long time, with solid fundamentals, attractive valuation, and, in relative terms, a supportive monetary policy. In Europe, the fundamentals are finally improving, and both the UK and also the Netherlands could provide bright spots in the coming quarter. The Netherlands, especially thanks to its exposure to artificial intelligence. Now, if we turn to emerging markets, the metrics show opportunities across various economies. However, of course, all eyes remain on China, where on the one hand, valuations and sentiment are attractive, but on the other, market participants are still expecting much more from the government.
Thanks, Greg. And the bond markets, how are you viewing those?
Well, on the bond side, you have the sovereign side, which remain constructive in the longer term, but we have seen that the conditions have become much more difficult for US Treasuries in the short term, as markets have reassessed the probability of Fed cuts and, of course, inflation risks. For corporates, as one would expect, a broader appetite for risk is fueling momentum. But we feel that the current valuations look quite high. This is particularly the case for high yields, with spreads barely compensating for default risk. And therefore, from a cross-asset view, we prefer US equities to US high yields.
So, given this positive sentiment and tailwind, what else should we be watching in the market right now?
Well, commodities will be broadly supported in the coming months, with better than expected economic data from Europe and China, OPEC supply also with quite some restriction, and of course, these geopolitical tensions which add to this positive mix. On the currency market, the Fed's pivot has led to a US dollar stabilization against the euro, yet interest rate differentials remain quite supportive for the greenback. Now, over the long term, we also see the Japanese yen as possibly the most undervalued major currency.
Thanks, Greg, for the comprehensive overview. Finally, could you offer our viewers something a little more granular? What about your current convictions?
Well, on fixed income, we like steepeners in countries like the US, Germany, and Italy, as they should benefit from potential rate cuts and the re-emergence of term premia. While we are, as you know, overweight equities, we also have some relative position open in some portfolios, with a preference for the Netherlands and Poland over the rest of Europe, while favoring Thailand in Southeast Asia. On the currency side, we're quite negative on the Swiss franc, as the Swiss National Bank has proven independent and domestic inflation is low thanks to a flexible economy.
Thanks, Greg. Insightful as ever, and thank you for joining us.
Thank you, everybody, and see you next time.